Hey guys, hope you and the families are doing well. I'm going to teach you one of my favorite simple swing trading setups on the daily chart in this video. To do that, we're going to need a little bit of pattern recognition. So one, be able to identify the specific types of candlesticks, which I call shakeout demand tails, and two, be able to identify these specific types of candlesticks in close proximity to one or more key daily moving averages. So to help illustrate and teach this simple setup, what I got is various precious metal miner charts loaded up. So I'll take you through a couple that I targeted, like AEM and Kinross Gold, and then I'll also show you Heckler Mining back from 1979 to illustrate this is timeless. It's been going on for decades and decades and decades, and I do not think anything is going to change. Market Search are today's video sponsor. If you're interested in a discounted trial, then you'll find a link to that in the description and the comment section below. Okay, here we go. So what I'm going to do is go through this in a logical process. One, I'm going to teach you how to identify the setup, which is obviously quite important. Two, I'm going to teach you how to control the risk by using various order entry method techniques and where to be placing initial stop losses. Three, I'm going to teach you about the risk mitigation. And then four, I'm going to teach you selling rules and selling guidelines to help optimize profits. So let's go gadget and begin with the trade identification. So as I said in the introduction, I call these shakeout demand tails, which are variations of hammer candlesticks, doji dragonflies, and Takuri lines. You'll see on the screen the data that Thomas Corsellis found from his book Encyclopedia of Candlestick Charts. Very, very useful to understand Japanese candlesticks, understand reversal rates in bull and bear markets. So what does a shakeout demand tail look like? Well, for me, it's just a combination of those three candlesticks. So a hammer, doji dragonfly, and Takuri line. So they look like this, right? So you can see various ones on the chart. You can see GDX, which is the gold miner ETF. This is a 50-day SMA shakeout demand tail. Here's a 21-day and 10-day EMA shakeout demand tail. Here's AEM, so I was then targeting it here. So this is AEM 21-day EMA shakeout demand tail. Repeated myself there, didn't I? This is Kinross Gold, so shakeout demand tail off the 50-day, and I was buying it through the high there. This is Heckler Mining in June 1979. So I've tried to line these charts up because what do you see? You see Kinross Gold in June 2024 put in a shakeout demand tail off its 50-day in the context of an uptrend, pulling back to the 50. Heckler Mining June 1979 in the context of an uptrend, pulls back into the 50-day. What do you see? A shakeout demand tail. Interesting. And then you can see various ones: AGI, 10-day EMA shakeout demand tail, and EM. You can see a 21-day EMA shakeout demand tail, a 10-day EMA shakeout demand tail. So I like looking for these shakeout demand tails. This is one of my main go-to setups that I like to look for. Even better, because you'll see various stocks here, the kind of four charts to the left-hand side. You'll see GDX, you see AEM, AGI, and NEM. A lot of E's there and a lot of M's there, aren't there? And a lot of A's. I don't know, maybe that's my dyslexia. Anyway, the point that I'm trying to get in, you can see these are all around the same time period as summer 2024. So if I see a specific group and a lot of stocks in those groups that are basing constructively, so those of you who watch a lot of my videos will realize that's a pretty constructive brace. Look at this big gap down reverse bar shakeout demand tail off the 50-day SMA. But I like looking for these shakeout demand tails if I see one, the group looks pretty strong and is setting up constructively, and a lot of the leaders in the group are also basing in a constructive manner. And then what you'll quite commonly get is the stocks will set up on the same day or around the same day in the group. So if I suddenly see, wow, there are 5, 10, 12, 15 precious metal miners that are all building bases and they've all just put in these shakeout demand tails, I'm going to be paying very, very, very close attention to that on the next day. So in terms of the pattern identification, so the real identification of the setup, I'm looking for a strong group relative to the market. Then I'm trying to look for the strongest stocks within the group. And then I'm looking for these shakeout demand tails, which are variations of hammers, doji dragonflies, and Takuri lines. That's the identification of the candlestick. Now, I like for it to be around one or more key moving averages. So this is the key point, one or more key moving averages. Okay, I'm not looking for a shakeout demand tail when it's up here. So you see GDX up here, it's extended from the 10-day EMA, which is the black line. So I want it to be around, so proximity to one or more key moving averages. The three most important ones on my charts are going to be the black, the blue, and the purple line. 10-day EMA, the black line, 21-day EMA, the blue line. Purple line is the 50-day simple period moving average. So you can see with AEM, so I'm then targeting it on this day here, but you can see the setup is on the prior session because you get the shakeout demand tail is showing a lot of relative strength versus GDX. So GDX is putting in its shakeout demand tail around the 50-day on the 9th of August, whereas AEM is putting in a shakeout demand tail above the 50-day around the 10 and 21-day on the 9th of August as well. So AEM is showing structural strength, relative strength to GDX, and also a lot of relative strength versus the major indexes, so the Qs and the S&P 500. So proximity to the moving averages is going to be important. So that kind of covers the trade identification. However, we now go into the controlling risk phase of the trade, which is then also the order entry method technique. So there's two main ways. There are buy stop limit orders, or there are opening range breakouts. So let's cover the buy stop limit order to begin with. So a buy stop limit order would be, if I maybe use Kinross Gold, this is one that I targeted down here. A buy stop limit order would be buying through the high of the shakeout demand tail. Potentially you're doing a buy stop limit order, potentially you're just watching it, then doing a market order or something like that, depends on the liquidity of the stock, and then placing the initial stop loss 1 cent below the low of the shakeout demand tail, assuming the risk makes sense. Now, what I like to look for is for the initial stop loss, okay, to be less than, ideally half to 2/3, but less than the 20-day ADR percentage, and ideally starts with a 4 or under. If it starts beginning with a 5, I'll probably pass on it because the risk versus reward is getting a little bit out of whack. So I like a nice tight initial stop loss relative to the 20-day ADR percentage of the stock. So if you see here, okay, let's just imagine it's 4.11%. It will be a little bit less at this time here, given the kind of move that this has made, and we'll talk about optimizing profits. But 2.9% initial stop relative to 4.11%. Now, of course, you want to be thinking about, you're probably going to get some slippage, you're not going to get perfect execution, but that's a way to think about the controlling risk with a buy stop limit order as the order entry method technique. On AEM, so with KGC, I bought it with a buy stop limit order in terms of the order entry method technique. With AEM, I use an opening range breakout on the 30-minute time frame. So one, I wanted to see the prior session's high was taken out, so it took out the high of 74.42, and then what I'm doing is then looking for a very strong opening range breakout, and I elected to use the 30-minute time frame. That is currently my preferred order entry method technique. If I'm using an opening range breakout, the 30-minute, it reduces false breakouts but still controls the risk and then can get me in when the momentum starts coming through. As you can see with AEM, I'm currently long this stock at the time of filming the video. So then what I was looking for is a break through the high of the shakeout demand tail, and I want to see evidence that there is a lot of buying. I call this bullish synchronicity, where you get those widespread candlesticks, volume confirming the positive price action. So that is then one way. So then it would be targeting it through the high of, say, the 30-minute ORB, stop loss low of the day, like that. So that is then two order entry method techniques to then get in the position and control the risk. And again, as I was saying with the buy stop limit order, thinking about the initial risk relative to the 20-day ADR percentage, I would do that with an opening range breakout as well. So I know you can't see the half an hour chart, but if you imagine it was something like this, and let's just say the initial risk on the trade is 1.5%, that's about half the 20-day ADR percentage. Like it, nice metric to be judging risk against, because you're using the own character of the stock in terms of the volatility of the stock, and then thinking about your initial stop loss relative to that. In terms of then the risk mitigation side of things, what I would then look to do is sell part of my position either at 1 times the initial stop loss, 2 times the initial stop loss, I may take off a third, or I may push my stop loss up. And if I've gone for an ORB, it's a bit more difficult to do that, given that my stop loss is already low of the day. However, if my stop loss was down here with, say, a buy stop limit order, I can be pushing it up. But then as the trade starts to move out, the point in which I'm trying to get myself to is to be a break even on the trade. So kind of the proverbial holy grail of trading for traders is to position yourself where potentially you've got half or 2/3 of your position, but it's effectively risk free. Can you get gap downs? Can you get slippages? Yes. But I'm trying to get myself to the point whereby I have no open risk on the trade and I only have upside potential. So I'm trying to get myself to the point where I can't lose any money. I can only make money on the trade. And I'm trying to get myself there pretty darn pronto as soon as I think a prudent opportunity presents. That's the risk mitigation element. And I teach you that in the blueprint video for free on the YouTube channel. Search the YouTube channel and you will find it. And then we go into the optimization of profit. So what does that mean? So we go with AEM. So stock that I'm currently long. So I was buying it 30-minute ORB in here. Okay. So what I like to do, I'm primarily a swing trader. I'm intermediate term trend follower. So what I'm trying to do is ride intermediate term trends. Now to do that, I think 10-day EMA, 21-day EMA moving averages are useful. So that's going to be the black and the blue line there on my charts. Potentially the 50-day, if it's the right type of stock in the right type of market. You'll hear me talk about thinking about moving average breadth readings. Are we overbought, oversold? So if we're oversold, that proverbial market tide has come out, and then it's going to flow back in. So that's something that will play a part. Invariably though, 10-day, 21-day is where I'm looking to use that more so. However, I will choke it off if it gets extended. So what I did with AEM is it's currently extended from the 10-day EMA. So quite commonly, I'll adjust my stop loss on all or part of the position to the low of the day. So I'm using the 10-day EMA as a trailing stop, or the 20 and or the 21-day EMA as a trailing stop. But if it gets short-term extended from, say, 10-day EMAs, I will choke the position off. Usually I will go low of the day. Now I may go intraday low of the day. Say if there's a nice bullish first half an hour candlestick, 1 hour candlestick, I may place my stop loss on the low of the day. I may wait until the end of the day and then put my stop loss there, because what I'm effectively trying to do, if I were to show you with AEM back here, here. I didn't have a position in AEM when it was doing this run. But the point is, if I think the stock is extended here, rather than me just guess and say, stock's extended, I'm chucking it out. We all know, if you've been trading for longer than 2 days, you'll know that extended stocks can become more extended. So it's the Darvis point. Let your stop loss decide. So that's what I try and do. Let my stop loss decide. So imagine if I had a position, if I got it here on this little gap, again, here I'm thinking, this looks really, really extended. Just go lower the day, lower the day, lower the day, lower the day, lower the day. And then I'm knocked out up here in that instance, rather than waiting for closes below the 10-day EMA, which would be over in this proximity over here, the 21-day EMA, you would have had a big gap down. So when these commodity stocks, precious metal miners included in that, start getting extended from 10-day EMAs, that is invariably when I'm looking to choke off part of the position. So AEI from this shakeout demand tail, okay, here it's getting extended. So if you thought here like, wow, this thing's so extended, I'm chucking it out, just go lower the day, lower the day, lower the day. Like that, and let your stop loss decide, because extended stocks can become more extended, and kind of that last kind of hurrah, that last push is oftentimes where you can get the greatest price appreciation in the shortest period of time. So what I would say is understand the stock you're trading, have kind of a game plan. If you're a swing trader, intermediate term trend follower on the daily chart, kind of think 10-day EMA, 21-day EMA, trailing stops, but have the ability, have the awareness to go, if something gets extended from the 10-day EMA, have the ability to go, yeah, part of the position, maybe all of the position, depends how extended, I'm just going to go lower the day with my stop loss and choke it off that way at the position. So optimizing profits, you want to think about the monetary gain, but you also want to think about the efficiency of the monetary gain, which is the time value element. So really hope you guys have enjoyed that video about shakeout demand tails. It's pretty simple. It's not that complicated. You're looking for strong stocks in the context of uptrends that then build what I call those shakeout demand tails around one or more key moving averages. You can then use buy stop limit orders. You can use opening range breakouts if they take out the high of the shakeout demand tail. You want to think about risk relative to 20-day ADR percentages. You want to think about the risk mitigation, and then you want to think about selling rules and guidelines that you are using to optimize your profits. So that is it. I'll wrap it up there. Thank you for watching. Thank you for supporting the YouTube channel. I will see you in a future video.